Hey everyone, it's Imran from Options Insight, and this is your macro options spotlight. Dollar caught a bid, unsurprisingly. Metals were weaker, obviously partly because of the dollar bid, but also just general China optimism fading again, back to locking places down again. Literally the day after the market gets excited about easing lockdown policy, easing zero COVID policy, they start locking stuff down again. So it's a bit of a joke. Anyway, the other stuff I'm seeing is oil obviously pulling back as well after that FOMC meeting, but still finishing up on the day, up about 1.3% there in USO. If we look at implied volatility, we saw in terms of the at the money vol in equities, it was slightly higher, but that's because equities dropped by 2.5%. So FX and bond vols coming down. You can see that they were pretty, kind of holding up there, whereas equity vol was a bit offered ahead of the meeting. But we see that sea of red there on the day with FX and bond vol, whereas you see a little bit of an uptick there in equity vol. Now the equity vol moves whilst at the money vol is higher. The actual fixed strike moves. So for a given option, let's say a 1 month option with an at the money strike, something like 37.50. If you analyze what the implied vol of that particular option did over the course of the day, it was down around 1 vol point. So that shows you that even though the floating level of at the money vol is higher because we've floated to a lower level of spot prices, the fixed strike volatility has gone down. And that is more indicative of whether dealers are reaching to buy vol or sell vol after the event. And that's a conclusive dealers were dumping volatility, dumping options after the event, as you normally would see after an event like the FOMC. We did see pretty wild swings in the S&P though, which is why the carries flipped to negative again. It's pretty amazing to me how much Europe isn't moving. Realized vol at 13, 21.5 on the implieds. And, it's kind of surprising that even though the S&P is swinging around like an animal, Europe just doesn't seem to move right now. It's annoying because I haven't sold any gamma on Europe yet because I've thought it was going to start to move, but it is pretty amazing to me that this thing refuses to move. Still got positive carry in oil, still got positive carry in bonds, although a little bit less, and then negative carry across the board in FX remains. Those implied volatilities getting hit and the market kind of moving a reasonable amount shows you why that is still in negative territory. In terms of skew, we are seeing milder moves in skew on the day, no massive moves. You're still seeing the trend in skew on oil. That's down 3 vol points on the week, which is a massive move in skew for oil, and that has flipped towards calls. Calls are trading 1.5 vols above the equivalent delta puts in the 1 month. And, markets in general just trying to digest the hawkish message out of the Fed, decide if tail risk is appropriately priced. Personally, I still think equity skew being at the absolute lows on the year is not appropriately priced. It's a bit underpriced. I think people have thrown in the towel on protection. Clearly, protection isn't working particularly well in the fact that we're not really crashing down. But I do think at some point when we take out the lows in equities, things should get a bit spicy again and vol may have a bit of a spike coming. So I don't mind owning a bit of skew. It's not like I've piled into loads of this stuff because clearly it hasn't been working, which is why it's priced quite cheaply. But I do think opportunistically picking up a bit of skew at these lower levels, if you're bearish on the market and you do perceive we make new lows, then it might not be the worst idea in the world. And I'd probably do it now ahead of the CPI data next week. I don't think non-farms personally moves the market as much as CPI does, although last time we had non-farms, the market dropped nearly 3%. So who knows? But we've got midterms, we've got non-farms, and we've got CPI in the next week. So shipping in some skew before then, if you think those numbers are potentially not going to be that bullish for the market, might not be the worst idea. All right, if we then move over to what else we're talking about. So obviously Powell leaving the S&P reeling. We were expecting, and we have been saying in our dailies this week that we thought Powell would reiterate the hawkish message. He came out and said it's premature to think of pausing rate hikes. So if we see the price action on the day, we had the FOMC statement, we had a strange rally post that statement, market thinking the statement itself was more dovish than expected because some of the language that they added in there. But then after the presser with Powell speaking, once he said premature to think about pausing, goodbye the S&P, and it finished from, up 0.5% to down 2.5%. So a nice 3% intraday sell-off there. That week close, obviously, not great for the bulls who had hoped for a dovish message. They're probably dumping their longs. Fair amount of fast money would have been puking out of that. That took the index down to 2.5% lower on the day, which is actually the worst Fed day performance since January 2021, which surprised me when I saw that metric. Now, the key data coming up over the next week and the midterms thrown in probably means the market's going to remain volatile. And the daily straddle on the S&P that was priced at 1.6% yesterday that we were saying we thought was a bit cheap turned out to be very cheap after all, especially if you traded it, because the round trip was like 3%. So, you know, more than double the implied move. So had you bought that straddle because you thought we're going to move one way or another, we then got that rally of about 50, 60 points initially, and you didn't buy that rally and you thought that rally was probably a fade, you could have hedged all that delta out that you've then acquired through owning that straddle, and then the market dumps 3% and you've had a fantastic result being long gamma over that day. So that would be the way you would have traded that as a vol trader. If you thought that thing was cheap initially, you didn't know which way the market was going to go, that thing gave you some nice gamma trading opportunity. All right, if we now look at what else is on my radar, it's all about oil right now. I think oil maybe is potentially the best opportunity in the fourth quarter right now. You know, I think other things are going to be choppy. They're going to be volatile. There's going to be a lot of noise. But what feels like in the oil market feels like this is becoming a clearer and clearer opportunity. And why do I think that? So we've previously mentioned that there's quite a dramatic repricing of oil skew that's going on, okay, over the last couple of weeks. So you can see from this chart of the 1 month skew, and the red line is 2 weeks ago, and the white line is as of yesterday's close. So you can see the at the money area hasn't really moved that much in volatility. Even on the put side, we can see that we have, where are we? We are white is now, right? So put side is coming down. So you had about a 2 vol point drop on those 80% puts. The 90% puts haven't done a whole lot. If anything, they're actually slightly higher. The at the monies, you can see here, are slightly lower. But what is going on the upside? So you're seeing the 5% out of the monies are up a vol, the 10% are up 2 vols, and the 20% are up 4 vols. So you're getting a massive move higher in upside. So demand for calls. Okay. So the smart money in the market is figuring out that the tail risk now in oil looks like it's coming to the upside. So they are demanding those calls, even in the face of general vol at the money vol in oil coming lower. And the fact that the carry in oil has been horrible from those green bars on our carry metric. So even though it's not realizing, there's still demand for that upside. So then the question is, does oil skew lead the price of oil? So when you see this type of move in oil, what does it tell you about what spot's going to do? So if we look back over the last couple of years, and you can see in this graph here, so the green line is the USO price, and the orange line is what skew is doing. So we've got a zero line here. The zero level is when the skew is completely neutral between calls and puts. So you can see that in periods when that skew moves up by a significant amount, okay, clearly there was a very significant amount earlier this year where it flipped from, you know, very negative to very positive. But basically, these are all the episodes of this skew flipping from put skew towards more neutral or even going into call skew territory. Okay. And in general, we can see that usually leads price going higher as well. So when you get this move up in the orange line, then what happens after that to the green line? It generally goes higher. Same thing here, this going up and prices going up. This explosion earlier this year, that was quite dramatic. But what happened? We saw this big ratchet higher in the oil price after the skew had already gone. Okay. And then now we're seeing it again. So we've seen it was pretty steep for puts. It's now flipped from kind of 7-8 vols for puts to actually now a vol point for calls. So a steep move there. And since that move, oil is pretty much unchanged, right? It hasn't really done a whole lot. So what we're looking for is that this skew pricing turns out to be correct. People are buying these calls for a good reason. And we basically see some sort of move into year end that takes this USO price above 80, 90, wherever it wants to go. So that's the idea. We'll see if it plays out that way. But fundamentally, there's also decent reasons to believe that this thing's going to be supported. We've been banging on about the SPR being released and that likely to slow down after the midterms. And then if you look at the other fundamentals like the gasoline inventories, the distillate inventories, they're at historically low levels, and crude oil production is going nowhere in the US, right? There's no incentive there for these guys to really bring production up, given what the Biden administration has been doing. So that's what we're thinking. We still like that trade. Now, we've obviously been pitching a few ideas in USO over the last sort of few weeks. The last thing in today's note, we're talking about the pound, what the volatilities have been doing in the pound, and the Bank of England is up today. As we speak, actually, I think the Bank of England's kind of announcing what they're going to do with rates. There's a press conference in 10 minutes. We'll see what they say. But in general, cable vol has come down massively from the highs. So has skew. General risk perception in the market has come down because the government did the U-turn that they needed to do to restore some hope of credibility with the new prime minister. And in general, selling vol has been the right trade, particularly selling calls. That was the thing that I had been doing. I've been short some 120 calls out to December because I felt that it was very unlikely we were going to get back above 120 on cable. And now those calls have made most of their money. They made like 90% of their premium. I bought them back this morning. So given the spot sell-off, didn't make a lot of sense to be short those anymore. I do still have some puts because they were part of a risk reversal. For now, I'm holding on to those puts because I think the risk reward is probably still to be short cable and bearish the pound. All right, that's it for today. Thanks for listening, guys. I'll catch you all tomorrow.